trading. We are learning trading to make money because we have money on the side and we want to invest it. So we need to understand how the market works, but the issue is we start doing some stuff and so on, and then we start losing money. And so then we understand, okay, maybe this technical analysis and so on, but so that's kind of overwhelming. There is just too much things. So let's make things simple and come back to the essence of what trading is. This is what we are going to talk about today. Trading. As I said, trading is something fun. We can make a lot of money out of it, but statistically speaking, most people are losing money. So, what are most people doing wrong that maybe we can avoid? The very best thing that actually most people are doing wrong is trying to predict the market, And the best trader in the world maybe are able to do that. But let's be honest. You that have learned trading not that far ago and so on. Do you really think that you are going to be able to do things that most people, most institutional professionals are doing, work entire days and have spent their life trying to be able to do and still get it wrong most of the time? So as a retail investor, retail trader, what is going to be the best way for you to actually make money on the stock market? It's going to be simple. Observe rather than predict. It just means you are focusing on observing what is going on and not trying to make assumption. This is simple. Just observe. You decide what you are going to do and you act. You are not expecting something to happen or predicting something that will happen. And so this is the difficult thing, because we want to predict, we want to have some certainty about what is going to happen and so on. But what you need to understand is trading is really about probability, where you are going to assess a probability outcome. Everything can happen. This is something that you need to understand. Everything can happen, but you are going to say, okay, I'm going to manage my risk accordingly. I think this outcome has more chance to happen than this outcome. You're not trying to predict which one is going to happen. You're just assessing what may happen and in which probability it could happen. You don't know what is going to happen. And then you take cold, rational decision in order to just execute on what you think is the best thing to do. So let's dive into a little bit. I'm going to share you the baseline of what a trader should have in mind. So this is that. You have on one side the market is going either in a trend, it's moving up or down, or it's moving kind of sideways. And so the strategy is simple. This is and every good strategy implement just that. And then people add stuff on top because they want to predict how things are going to happen. But the truth is, you are just objectively observing the market. Is it trending? Is it not trending? Is it ranging? And depending on whether or not you are in one or the other situation, you are going to act. And so how do you act? This is simple. if the market is moving down, as I show with the trending and the red dot, you're selling on the red dot. This is simple. The market is trending because the market is trending down. You're not anticipating, so go with it. That's it. And so you will take wins as you go with the trend, and at some point the trend will reverse. That can happen. That's something that will happen, and so you will probably take a loss. And that's part of trading. That's why you want to manage your risk. Never risk more than 1% of your account on every trade. This is because of that. You are just observing. Most of the time, if you are observing right, you will make money, and some of the time you will lose money. And so you cannot predict which one is going to come and when. So the best way to go about it is just to manage your risk. Just risk 1% on every trade, diversify on multiple assets, and so you are reducing your risk over time. Then when the market is moving up, you are buying the dips. If you see that the market is trending up, you buy the dips. And then when you think the market is ranging, it's just going nowhere, okay. Every time it go up significantly, you sell. Every time it go down significantly, you buy. This USDC is primarily around the middle of the range, because range are really non-directional, so the price can move into the middle of the range, then come back to the top, then come back to the bottom. There is no really direction. What you know is just there is high likelihood that the price is going to come back to the middle of the range, so you can exit at this point. And then in a trending environment, you're just moving each time. What you can do is scaling out of your position on the way up, then adding to your position on the way down. So each time there is a new dip, you add to your position and you raise your stop, so you exit each time it go below a dip, or the opposite if the market is moving down. So this is really those two things. And so there is no thing very much, there is no much more complicated stuff than that. The trading strategy is as simple. Everybody that is trading on the market is just making some variation of it using some fancy tool and so on. The real difficulty, so if you remove this aspect of trying to predict and you want to observe what is, this is okay, ranging versus trending. How can I make the difference? How can I find the right spots? How do I know? How do I know if the market is trending or if it's ranging? And that's the good question actually. You are not trying to say, okay, is it the market going to rise? Is it the market going to go sideways in the future? What it is doing right now? That is a very good question. So let's dive this we have seen. Now let's go into the charts. The best way to go about it is, if you have any doubt, the market is probably ranging. Generally speaking, when the market is trending, there is no doubt the market is trending. If we take a look, for instance, at the S&P 500, you can see here, is it trending or ranging? Your guess. I would say it's trending. It's trending, and it has done so for a very long time. You see, so even if the economics is really bad, even if everything is going wrong, the market is trending. So stop anticipating, because by anticipating you will have lost the opportunity to take advantage of this big trend. And so if we go to the daily, So you add, if you follow the basic strategy that I told you, you add one dip here, you add another here, you add another here, another here, another here. So you see, and so on. There is multiple. So you see, if you have just bought the dip every time, and you just don't worry about the fact that the stock market may go down, but so you will have make money all this way. And so you are having your stop. Each time there is a new dip, as you see, you are raising your stop. So let's suppose we have entered here at first, then we move the stop here, then we move the stop here, 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 and here we got stopped out. So okay, maybe the trend is over, maybe not. So if we take a look on a bigger scale, we may so on the weekly chart. So this is that. If on the, this is also that you need to just watch on different time frames what is going on, and so then you can take better decision. So we see that on the longer time frame, this is just a dip of the weekly time frame, and so this one might be a dip that we want to buy to enter in a new position. That's it. And so, but of course the S&P is special, it's trending a lot, and so as I said, here, is it trending or ranging? My guess it's ranging. There is a high likelihood that this is ranging. So we have kind of border of the range somewhere here, border of the range somewhere here, and so you're going on. We have seen, okay, so each time the price get out of the range, you know, okay, there is a high likelihood that it's going to come in the middle of the range. I didn't see the chart after, so let's walk through. I have no idea what is going to happen after that. So here, same, you see, we get out of the range, so we sell. Oh, actually, this is the end of the day, but you see the middle of the range is somewhere around there. So if you have sold at the middle of the range, that was a good trade. Same here, middle of the range. Same here, middle of the range. And so, as I said, is it trending or is it ranging? So let's move on back a little bit. So, yeah. Is it ranging? Trending? Here it's ranging. No clear direction. Up, and here we may have a loss, and that's why that's some subtleties that we can add to it. Maybe if we get out of the range, we only buy when we re-enter into that range, and put our stop just outside of this range here, and then because this is a trend that is starting, okay, we got stopped out. Then we are seeing that the market is trending pretty much. So here we have a pullback. So we are just observing the market is trending. So we are not expecting anything else. We are selling this pullback simply, and we make a little bit of gain. That's fine. We move our stop loss and so on. And there now, okay, we haven't made a new high. Is here also maybe so far we will have things that maybe the trend is not over, so we could sell also here, maybe make a little bit of profit. But here, okay, now we can say this is difficult to say at this point that market is continue to actually trend. So for now, okay, maybe the market is just trending. So we could sell just right there. Up. Right there, we exit at the middle of the range, and so on and so on. Yes. Anyway, so I hope it helped. I hope you have a better overview and understanding of what the market is, how you can. There is really all the things that people are adding on top of those basic principles of trading are just because they are trying to predict the future. They are trying to have some certainty about what is going to happen. But as investor and as trader, especially if you are not advanced, your job is only to observe, decide, and execute with cold, rational decision. No emotion involved. You observe what is happening, and you are acting. And the only thing that you may do in order to add to your conviction on what you are doing is look at higher time frame. If, for instance, if you are taking trades on the daily chart, look at what is going on the weekly chart and on the monthly chart. Because if, for instance, those are trending, yes, you are observing that those are trending, so you are going on the daily time frame with the trend. You are not trying to go against it and so on. And so that might be something so a little bit more advanced, where if the how I said if the trend, if you have a range on the daily time frame but the weekly time frame is moving up, what you may want is only focusing on so the weekly time frame is going up and you have a range on the daily time frame. What you may want to focusing on is only buying the bottom of the range, because the likelihood that the price is going to continue to go up and even get out of the range and continue the trend is higher. This is simple. There is no. And you see, I'm not talking about any indicator. I'm not talking about anything. This is just basic stuff. And you just doing that, you can make a decent amount of money, but always manage your risk, because we are only talking about probabilities here. Anything can happen. Anything. There is no certainties. And so that's maybe the difficult part. It's because trading is being able to take decision in an in an environment with a lot of uncertainty. So we are just assessing probabilities. What are the probabilities of this going up versus it going down? Both, I know that both can happen, but using higher time frame and so on, we say, okay, the market is currently doing that, so I am going with it. And so the likelihood that things are going to go in my way are higher. That's just how it is. So I hope it's clear. I hope it helped. And yeah, I think that's it for today. So thanks you for watching, and I see you next time.